Navigating market volatility requires a strategic approach, especially for retirees. A balanced portfolio, diversified across various asset classes, can offer protection against the unpredictable waves of financial markets. A blend of stocks, bonds, and other investments should align with your retirement timeline and risk tolerance. Regular portfolio rebalancing can help manage risk while capitalizing on market shifts. Dollar cost averaging, where you invest at consistent intervals, can diminish the impact of volatility and reduce the average investment cost over time. Staying informed about market trends and economic indicators enables wiser, more grounded decision-making. However, focus on your long-term objectives and avoid making impulsive choices based on short-term market fluctuations. Consulting a financial advisor can offer personalized advice and help to navigate through uncertain times. Try to keep your emotions in check. Avoid panic selling and embrace patience, keeping your long-term financial goals firmly in view. Emily, I read that you admitted to having perfectionist tendencies when you were young. I think that can oftentimes shape our behavior. Mm-hmm. How can retirees maintain emotional stability and avoid panic selling during market downturns?
So I think part of the problem with the mindset during retirement is we have this tendency to look at our money as like a Scrooge McDuck thing, where like it's investment and like accumulation, and then you stop and then it's drawdown. So like Scrooge McDuck, you've got this big vault and you take the gold coins out of it and spend it. The problem is that that's not how investing works, and you actually can still have a long timeline as of the day you retire. So if you're thinking like, I have to have X number of dollars in my nest egg because that's when I'm going to start drawdown, and it's just going to be, I'm drawing it down from then until I die, that is going to cause a lot of panic and a perfectionist thinking. Like, well, if I don't do everything perfectly now, I'm going to screw things up for when I'm 80. So remembering that investing is a lifetime process. And so you still have the ability to enjoy a long time horizon, even in your 60s and even potentially in your 70s, meaning that you can have some portion of your nest egg invested for long term in more volatile assets, while you've got shorter term investments in things that are less volatile. So you're more likely to recognize when fluctuations don't actually touch what you are going to be living on next year or in 5 years. It's only something that might affect your 20-year plan, and that you've got time to wait out.
With any luck, our investment timeline is longer and longer. Colleen, I want to ask you, Vanguard's approach to retirement planning, it emphasizes a total return strategy rather than income-focused strategy. What are the benefits?
Sure, Andy. I would say the primary benefit of total return is that it really allows investors to maintain their broadly diversified low-cost portfolio, right? And not shift the portfolio to, say, higher dividend-paying stocks or higher yielding bonds for the sole purpose of generating cash flows, right? When we're thinking about managing retirement and having more financial planning predictability, right? A lot of the strategies analysis are run on like long-term simulations of indices. So as you move away from investing in index type products, you just introduce more variability and the more opportunity to kind of stray from the predictability of the plan.
David, you've done a lot of work on dynamic spending. How can that shape how retirees define and adapt to risk?
Yeah, I mean, this is going to shock all of us, but retirees don't make a single set of decisions at retirement and then just follow that blindly for 20 or 30 years, right? In real life, individuals are always kind of revisiting their situation. And when we acknowledge that in any kind of model, it can really change the definition of what is the right thing to do. So how much risk do I take in a portfolio? How much can I spend? All that is really affected by this idea that individuals adjust over time. I think the larger issue is that the tools we use don't accurately capture that. So I think we're seeing more tools that capture this, but long story short, when you allow for dynamic changes, you can spend more, you can invest more aggressively. It really turned out to be kind of a win-win for retirees.
Is there an optimal frequency that retirees and their advisor, if they're working with an advisor, should be revisiting and making those adjustments?
So, I mean, I always say once a year. And I think that, when you talk about dynamic adjustments, and I do as well, I know Wade and I have been doing this for like a decade. The issue is not that advisors don't do it with clients. It's just not included in the financial plan itself. So when I've talked about this to advisors, they say, that's what I do every year. And I say, well, the problem is the tools that you use to show the clients what the outcome is don't incorporate your future changes. So I would say at least once a year, but obviously more frequently, potentially, as situations change.
Wade, I don't know if you have thoughts to add to that, but I want to ask you, can you discuss the role that annuities might play in a retiree's portfolio to combat market volatility?
Sure, and certainly there is a role for a purely total return strategy, but I've focused on a lot of research about this idea that there's retirement income styles, and people have different preferences about how much are they comfortable relying on the market versus having protections. How much do they emphasize having optionality for all of their assets versus being able to commit to a strategy that will solve for a lifetime need? And so what we find is about a third of the population is comfortable with a purely total returns investing approach that really models what's done pre-retirement and applies it to the retirement problem. 2/3 of the population is looking for protections or commitments that a purely investment-based strategy can't provide. And so that opens up a conversation around things like annuities, which provide risk pooling and longevity credits to support retirement spending in a manner that's competitive with anything that the stock market might provide through the risk premium, with the idea that stocks will outperform bonds. So people really have a choice to make regarding, do they want to go the direction of risk premium through the stock market or risk pooling through insurance? And so there's a lot of choices, a lot of flexibility. People can design a strategy that they're most comfortable with at the end of the day. And annuities may be part of that for potentially up to 2/3 of the population who may not already have enough annuity income through things like Social Security and traditional company pensions.
Yeah, 2/3 of the population is pretty high. Do you have a recommended, what percentage of a retiree's portfolio they should consider in putting into an annuity?
Well, there's two general approaches taken to answer that type of question. My preferred approach is it involves people knowing their budget for retirement. But you look at what reliable income do you already have between Social Security, pensions. If there's a gap where, say, I'd like to have $60,000 of reliable income, I already have $50,000, so there's a $10,000 gap. Then I would look at, well, how much would it take to fill that gap with an annuity? Is that a reasonable percentage of the asset base? That's my preferred approach, but sometimes the question is framed more as asset allocation. What should I allocate to stocks, bonds, and annuities? Because people may not necessarily know what their budget is for retirement, and they just want to maximize their overall spending. So in that sort of approach, I think it's important to think about annuities as a bond alternative rather than a stock alternative. And so to the extent, whatever your bond allocation would be, taking a portion of that and earmarking it towards protected lifetime income could be a good way to think about building a percentage of my portfolio with that sort of income source.
Thank you for that. I sometimes have clients coming to me as an advisor who I think that they had a very aggressive agent or salesperson who has them put too much of their portfolio into an annuity. And then because there are penalties, there's some illiquidity associated with the annuity, that then they have some trouble figuring out, well, how do I course correct? Because I think that I have too much.
Mm-hmm. Yeah, that can definitely be an issue, especially if they're not being used for the stated goal of what that person's trying to solve with their retirement plan.
Correct. Well, let's go into segment 2.